Welcome back. Before we take a look at the day's business news, let's take a look at the stock indices across the GCC. Arabtec Holding, one of the Middle East's largest construction companies, is heading into real estate development with the launch of a new property subsidiary. Arabtec Real Estate Development Company will initially develop residential housing in Abu Dhabi and Dubai before expanding into other GCC countries and the wider Middle East and North Africa market via joint ventures with other real estate developers, according to a company statement. The subsidiary is being launched to focus on opportunities to develop affordable housing, a segment Arabtec said is severely underserved, with an estimated shortage of more than 3.6 million affordable housing units in the MENA region. Arabtec Real Estate will rapidly expand in key potential markets, including Saudi Arabia, Egypt, Algeria and Morocco, along with the UAE. UAE exports to Italy increased by 127.4% from January to September 2013, while Italian imports to the UAE grew at just 3.7% following 2 years of double-digit growth. In the first 9 months of the year, UAE exports to Italy reached 1.13 billion euros. Italian imports reached 4.16 billion euros compared to 4.02 billion euros. Whereas last year, Italian imports to the UAE increased by 16.6% year-on-year, and in 2011 rose by 28.3%. The rise in UAE exports is being driven by 575,101,000 euros in ships and vessels trade over the January to September period, while oil and refining-related products account for 254,339,000 euros. Since the 2011 Libyan revolution, Italy has looked elsewhere, including the UAE, to meet its domestic energy demands. In 2010, the UAE did not export crude oil to Italy and exported just 69,889,000 euros of oil refining-related products. Italy is starting its bounce back from 2 recessions that have cut 9.1% of its GDP since 2007. Travel between the two countries is also on the rise, with the number of European Schengen visas issued by the Dubai consulate increasing from 9,000 in 2011 up to 25,000 in 2013. Dubai retail group Majid Al Futtaim on Sunday announced plans to invest $467 million to build a shopping mall in the neighbouring Gulf state of Oman. Built on 157,000 square metres of land in the capital Muscat, Mall of Oman will have 350 stores, including a Carrefour outlet and a cinema complex. The project will be Oman's largest shopping and entertainment complex and is expected to be completed in the fourth quarter of 2017. Majid Al Futtaim, the sole franchisee of Carrefour hypermarkets in the region, said 1,500 jobs would be created during the construction of the mall, and an additional 3,500 permanent jobs were expected once the shopping mall was open. UAE-based hotel management firm Rotana plans to double its number of hotel rooms in the country. The group, which manages 32 properties with 8,700 rooms in the UAE, plans to double its domestic room inventory in 5 years in anticipation for the rise in demand from Dubai's hosting of Expo 2020. Next year, Rotana will open the 257-room Hilli Rayhan in Al Ain, and its Arjan Capital Centre in Abu Dhabi is expected to open towards the end of next year, according to a local report quoting Omar Khadouri, Rotana's executive vice president and its chief executive. As of the end of last month, the UAE had 109 hotels in the development pipeline, accounting for 31,262 rooms, according to the industry research firm STR Global. And in its final meeting of the year and the final meeting of Fed Chairman Ben Bernanke's tenure, the FOMC voted to cut their current asset purchase program by $10 billion to a revised $75 billion per month. Citing a healthier US economy and the lack of inflationary concern, it was the first such cut by the FOMC to its asset purchase program, which was introduced in 2008. In his final remarks, the Fed chairman stated that the FOMC had pushed back its timeframe for raising rates and that they would continue to monitor the condition of the labour markets. Markets were volatile following the announcement but digested the news on a positive tone, with US equity markets soaring and the US dollar making gains. To talk about this further, we earlier spoke with Gaurav Kashyap, the head of futures at Alpari Middle East, on what this means for markets and what to look forward to in the year ahead.
Well, with the Fed taper story well and truly out of the way now, I think markets will continue to focus on the basics, and the underlying fundamentals will be the core driver of prices throughout the first quarter of 2014. I think markets will now look at the data for what it actually is. Improving data could see higher equity markets as well as higher markets for the higher yielding assets, with the dollar remaining on the back foot. But as I said, with the uncertainty being removed now, the Fed decision is now in the books. It's done and dusted. There could be the odd Fed meeting where we see a potential hold to their current asset purchases instead of further cutting, but I don't think this will lead to too much uncertainty. So I think once again the markets will move to just looking at how the data does come out. Overall, for the last week of December, we can expect very illiquid market trading conditions. A lot of market participants have already booked their profits following the announcement last week. They're on the sidelines. We have Christmas coming up in this week. It's a shortened trading week. So overall, we're not expecting too many major surprises. We could see a slight bump in markets, maybe a 1 to 1.5% spike on the Santa Claus rally, what we call the Santa Claus rally. But overall, now the attention will focus towards January. January sees the announcement for Q4 earnings. Once again, better earnings will be better for equity markets. We could continue to see record highs in the equity markets. With regards to this particular week ahead, as I mentioned, we will be closed for Christmas. But overall, we will look at personal spending and personal income due out this evening, as well as durable goods due out tomorrow. But overall, not too many expectations or surprises in the markets. The euro should be trading between 136 and 138. Once again, gold looks vulnerable to test that 1180 level, with the British pound also trading between 163 and 165 in the week ahead.